Dear friends and investors, welcome to our monthly communication on markets and investing. So, what are we going to talk about this month? Well, quite a bit, as it is earnings season, and this is a point in time where we disconnect between the narratives and the reality that we see in numbers, right? And as you all know, that in the especially last 12 months, we have seen a constant shift in the macro narrative, right? It started last year with most central banks talking about transitory inflation. Then they panicked and realized that inflation was running ahead of their expectations and they needed to act very quickly. And that got them to start raising rates aggressively to tackle inflation. And we saw the resultant correction in markets as a result of that. And then suddenly, in a few months, the fear of not inflation, but recession started to set in. And we continue to see this flip-flop between this macro situation where the market tries to anticipate and price in an event, and we don't really know whether that event will actually happen, how severe it would be, and therefore that has caused a continuous confusion in the minds of investors and strategists as to should they position themselves for higher inflation and higher rates, or should they position for a recession. But in our view, all of this is not really relevant in the long-term context. Yes, macros are very important, but I think more than the narratives, we tend to take solace from the numbers. And today we will talk about that even though the earnings season is underway, what are the trends that we are seeing in the numbers and what can we conclude from that? So what we did was that we looked at the NSE 500 companies, which is a very broad base of the top 500 companies in the country. And as per the last count, almost 247, almost halfway, companies have come up with their results. And the total market cap of these 247 out of 500 companies is about 62%. So it's, a reasonable large chunk of companies. Now, if you look at year-on-year comparisons of the first quarter of this year with the first quarter of last year, the numbers look phenomenal, right? The numbers are that top line has grown by 38% and PAT has grown by 23%. But the problem is that last year we had a very low base because of the second wave of COVID, and this year was a first full-fledged quarter where there was no lockdown or disruption because of COVID. If we were to compare quarter on quarter, again, it would not give you the right comparison because usually the fourth quarter of the financial year is always a large, bulky quarter, and first quarter is usually a slower quarter. And despite that, we have seen that top line quarter on quarter has grown 2%, but we have seen clearly a 230 basis point impact on margins for non-financial or bank companies. So we've taken the financials and the banks out for comparison. And obviously this quarter, as we know that commodity prices increased, inflation increased, it has taken some impact on the EBITDA margins. However, if you take a 2-year CAGR, then the numbers are fairly strong. If you include all companies, including banks and financials, then revenues are up 43% and EBITDA is up 48%. If you exclude the banks, then revenue is up 50% and EBITDA is up 87%. So I think what the numbers are telling you is that on a 2-year CAGR basis, the broad set of companies are showing fairly resilient and robust performance. And we hope that this will continue over the next few quarters, as hopefully 2022-23 becomes the first normal year for most companies to operate, right? So that's where we are when we look at the big picture. Our confidence in the markets, as you all know, has largely rested on our hypothesis that India is seeing a significant improvement in the overall profitability and earnings growth of the corporate sector, and especially of the listed universe, and that is clearly coming through in the numbers that we are seeing so far. And this is despite the impact on raw material prices and the impact on EBITDA margins. I mean, let's take the first sector that we're going to discuss today, which is the automotive sector, which kind of broadly falls into the consumer discretionary sector, but we are talking about it separately because, as you would have seen, we have increased our exposure to auto and auto ancillaries in client portfolios. And the reason for that is that we believe that the last few years was very, very tough for the auto industry. We had a lot of issues from regulations, from rising raw material prices, supply chain disruptions, and COVID, right? So almost everything came together, and the automotive companies could not really fulfill their best potential, both in terms of production and sales. Production because of availability of semiconductors and chips, and sales because of continuous lockdowns and people just were not mobile enough. But we believe that as the semiconductor situation improves, we will start to see a significant improvement in volume growth. We have also started to see that raw material prices have started to soften, and we believe that margins which have gotten impacted should also trend higher. Having said that, one of the very interesting things that we are seeing if you were to just initially talk about the volume numbers, right, and in two-wheelers, I think two companies stand out, TVS and Eicher. Both of them have done reasonably well on a year-on-year basis. And if you were to compare it with the first quarter of FY20, then they're almost reaching there. On the other hand, Bajaj is still a good 25% below the 19-20 Q1 levels. So Bajaj has to recoup a lot of volumes, but TVS and Eicher have done a far better job when it comes to volumes. We also believe that in the recent quarter, Bajaj had an impact on exports. As you know, that Bajaj almost sells 55% of its volumes in exports, largely to African, Latin American, and Southeast Asian countries. And as you know, that in the run-up to rising rates, there has been a lot of currency volatility, and availability of dollars in some of the large markets that Bajaj exports to has been a problem. We don't think it is a permanent, but we believe that the impact of that should remain. Having said that, I think that what the two-wheeler companies have really excelled in doing is, despite volatility in raw materials and availability of chips, they have been able to hold on to their margins reasonably well. If you look at TVS Motors, I think they've done a phenomenal job. Their margins have been held at 10% constantly for the last 4 quarters, despite a significant impact on raw material prices. Even Bajaj Auto in this quarter has, despite exports slowing down, their margins have been held reasonably well. Both TVS and Bajaj are focusing on ramping up their electric vehicle production which is ramping up much, much faster. Eicher, which does not have a disruption with electric vehicles because it operates in a very different category, has seen very good volume growth. We don't yet have the results of Eicher, but the volume growth has been very, very good. If we now talk about four-wheelers, what we have seen is that both Maruti and Tata Motors had weak margins, right? We have seen that margins have suffered in four-wheelers. In the case of Maruti, however, the saving grace is an extremely strong order backlog of the two new launches that they have done. And this order backlog tells you that the next few quarters are likely to be fairly robust. In fact, we've even seen in the case of Mahindra & Mahindra, who opened up bookings for their SUV, the Scorpio, and they have seen record bookings. So I think that the automotive industry is seeing fairly strong record bookings. Tata Motors, obviously we like the name, but we do believe that the chip shortage was a big headwind for the company. However, this quarter they had an adverse mix and JLR margins were not up to the mark. But having said that, the management has shown significant confidence by holding their guidance of a 5% EBIT margin and a positive FCF for JLR in FY24. So we do believe that incrementally Tata Motors should also do well, but given the fact that a large part of the JLR is global, there will be a lot of volatility in the volumes and margins, but I think the direction is very strong. Having said that, they have just absolutely done a fabulous job when it comes to the domestic commercial vehicle and passenger vehicle business. And their first quarter volumes are up almost 100% versus last year. And if you take a 3-year CAGR, they are up 68%. So they're really, really killing it when it comes to domestic volumes. Amongst the ancillaries, Sundaram Fasteners came up with very strong numbers. We saw an uptick in margins. So last quarter in Q4, where margins were 14%, went up to 16%, as they were able to pass on some of the raw material cost to the customers. We've seen a good uptick in commercial vehicles and passenger vehicle sales, which means that top line growth has been robust at 43%. Also, what is heartening is that they have started to get electric vehicle component orders from a large OEM in North America, and they are developing many new products from there. Coming to the next sector, which is again a very, very important sector, which is financials. We believe that it's been a great start to the year, the first quarter of what we believe will be one of the best years for financials after a very tough 2 years of COVIDs and provisioning and whatnot. And I think the two financials that we own largely is Bajaj and ICICI Bank. And both of them really stood out amongst the crowd in Q1. Bajaj continues to literally fire on all cylinders. They added a record 2.7 million customers, which is the highest that they've ever done, taking their total customer base to almost 60 million. Now, there was a fear in the market that maybe Bajaj Finance will not be able to go back to the old growth rates that it had seen in the past. We do believe that the first quarter numbers gives us the confidence that I think Bajaj is back onto a very, very strong growth path as it lays out its digital journey. The transformation is going on very satisfactorily. The new Xperia app, we have seen customers inch up from 19 million last quarter to 23 million. We believe that the complete rollout of the digital infrastructure should happen by the end of the fourth quarter, and we are fairly confident that it will continue to command a higher multiple and premium for superior growth and superior return on equity. And we believe that this growth and improvement in profitability is coming despite a disproportionate spending that they are doing on their digital infrastructure and increasing the footprint in deeper into India. So next year, we believe that there will be some efficiency on the cost to income ratio that will come in. Coming to ICICI Bank, I think ICICI Bank is the new 20% growth stock, right? That was a crown for many years and decades was with HDFC Bank, because unfailingly HDFC Bank would consistently year after year, quarter after quarter, deliver 18 to 20% growth. We believe that that crown has now gone from HDFC Bank to ICICI Bank. It virtually excelled in every line item of business and there was no complaints whatsoever. So we believe ICICI is the new 20% growth stock and has outperformed on all parameters. And this is very important because I think that we as Alchemy took a very conscious decision that we chose Bajaj and ICICI Bank to be the fulcrum of our exposure to financial services. Both these banks have outperformed their peers, not only in terms of metrics, financial metrics, but also in stock price performance. We also have an interesting exposure in the non-lending space to Angel One, which you all know is a very fast growing, rapid, digital only broking platform, right? And they continue to increase their market share. In fact, in the first quarter of 23, their market share of active NSE clients went up to almost 18.4%. And now for a couple of months, Angel One is actually doing a better job in terms of customer acquisition as compared to Zerodha, which was considered to be a leader in the digital online broking space. So we believe that despite a tough quarter where volumes went down, markets were very volatile, but the company continues to spend on its digital platform. This year, they will migrate most of their clients to the new app, and we believe that it's a great play on both financialization of savings and digitization in financial services. We come to the next sector, which is IT services. We've talked a lot about this sector in the previous video, so I will run this through pretty quickly. But most of the results in the IT sector are out, and there are a few trends that are very clearly visible. First of all, the sector substantially corrected in stock prices because of the fear of recession in the US. Now, if we look at the numbers, what do the numbers tell us? When it comes to software services companies and large IT services companies, we have seen that both in Q4 and Q2, from about a 4 to 5% Q on Q growth has slipped to about 2.5 odd percent. Nothing to worry about, but yes, growth has slowed. On the other hand, if you look at the ER&D companies, there has been virtually no impact on their quarter-on-quarter growth performance, right? The ER&D companies and the larger IT services companies from Q1 of last year, for the several quarters were running almost hand in hand. They were all growing in the range of 5 to 6% quarter on quarter. But now for the last 2 quarters, the bigger IT service companies, the growth has slowed to about 2.5%. But for the ER&D companies, their growth remains absolutely solid at 5% plus. And obviously our exposure to ER&D companies was very deliberate and strategic, and that is clearly playing out if you even look at the stock performance. Barring one quarter of Q2 FY22, the ER&D pack has consistently outperformed the pure play IT services company. We expect this trend to play out in the long term as well, and reinforcing our presence towards our investments in these versus the pure play IT services companies. And now coming to the last sector, which is consumers. As you all know, that this sector took a significant brunt of the COVID lockdowns, and many of these businesses had to shut down. They had a couple of quarters where they just couldn't operate and had to take a significant hit on their sales. But if you were to look at the numbers that have come up in Q1, without exception, each of the companies has fared phenomenally well. If you look at your year-on-year comparisons, the growth has been anywhere from 40% to 200%. If you look at a quarter-on-quarter comparisons, then growth has been anywhere from 7 to 75%, right? And even if you look at the EBITDA growth, I think that along with the improvement in top line growth, we are seeing a significant swing in the EBITDA growth as well. So we believe that the entire consumer pack and the ones that we hold, United Spirits, Varun Beverages, Avenue Supermart, Titan, Jubilant Foodworks, and Barbecue Nation, we believe all these companies will show very, very robust numbers this year, and they will benefit from the significant opening up of the economy. In United Spirits, we believe that their premium portfolio continues to grow fairly strongly. Yes, we would have expected a better performance on the volume growth front, but we believe that over the next few quarters, they should catch up on volumes. Margins continue to be fairly strong. Varun really performed extremely well and is today one of the fastest growing consumer companies, benefited from a great summer season and delivered absolutely phenomenal numbers. We believe that it should continue to track fairly strongly. Titan is also literally firing on all cylinders. Every single business line of theirs, whether it was watches, jewelry, or eyewear, improved both on top line and margin performance. And I think truly a standout execution quarter in Q1. We do believe that Titan will continue to execute phenomenally well, and we hope that not only this marriage season but the upcoming festive season will continue to see very, very strong numbers from Titan. Jubilant has seen some stock price volatility with the exit of its CEO, but now the new CEO is in place. We believe Jubilant has the best franchise and the best gross margins in the industry, and we believe that as the economy opens up, it will continue to deliver robustly. We believe that the correction in the stock price when we actually entered Jubilant was a great opportunity. Post Jubilant, we have Barbecue Nation, which we believe is an upcoming and a very, very promising QSR and dining story. It has the best gross margin profile amongst the QSR companies, second only to Jubilant. Having said that, we believe that they have executed phenomenally during the tough COVID quarters and now are on the onset of delivering very strong numbers over the next few quarters and years. So with that, we round up 4 significant sectors. We talked about autos, we talked about financial services, we talked about IT, and finally we rounded up with consumers. We believe we are quite happy with the underlying growth that we are seeing and the progress of the underlying companies that we are seeing in Q1 thus far. And we do believe that India continues to grow. The numbers give us a lot of confidence that there is an underlying momentum in the economy, and especially in the companies that we have chosen in our portfolio. We believe that by next month, when we will talk, we will virtually have all the numbers out, and we will talk about that next month. Thank you again for your patient listening.